You probably believe the money in your bank account belongs entirely to you. Your name is on the account. Your salary is deposited there. The balance appears under your control. So the assumption feels obvious. If the money is yours, you decide how it is used. But hidden inside the structure of modern banking is a quieter reality. Many of the rules governing your access to that money were already accepted long before you ever used the account. Not because you studied them, not because they were explained clearly, but because you agreed to them the moment you opened the account. And most people never realize what those agreements actually allow. When someone opens a bank account today, the process feels routine. You provide identification. You sign a few digital forms. You accept the terms and conditions. The entire process can take less than 10 minutes. But within those terms exists the legal framework that defines how the relationship between you and the financial system actually works. That framework rarely resembles the intuitive assumption people carry about ownership and control. Instead, it defines something more conditional: participation. Modern banking operates through contracts that establish the rules under which financial institutions provide services. These contracts outline what banks promise to provide and what rights they retain in order to manage risk, comply with regulations, and maintain system stability. Most people never read these documents. Even if they try, the language often appears dense and technical. Pages of clauses describing liability limitations, compliance obligations, transaction monitoring, account restrictions, and institutional authority. From the perspective of the user, the account simply works, so the details feel unimportant. Until the moment the system behaves differently than expected. A transaction is declined. An account becomes restricted. A transfer is paused for review. And suddenly the question appears, how can the bank do that if the money belongs to you? The answer lies inside the agreement that was accepted long before the problem appeared. That agreement grants financial institutions a series of powers necessary to operate within modern regulatory frameworks. Banks are required to monitor transactions for suspicious activity. They must comply with anti-money laundering laws. They must screen accounts against sanctions lists. They must detect fraud. They must protect their own liquidity and operational stability. To fulfill those obligations, banks must retain the authority to intervene in account activity. That authority is written directly into the agreements that define the relationship between customer and institution. The agreement allows the bank to delay transactions when unusual patterns appear. It allows the bank to request verification. It allows the bank to suspend activity while investigating potential issues. And in some circumstances, it allows the bank to freeze the account entirely. These actions do not require permission at the moment they occur, because permission was already granted when the account was opened, quietly, almost automatically. This structure reflects something deeper about the architecture of modern financial systems. Banks do not merely store money. They operate infrastructure. That infrastructure processes billions of transactions each day across complex networks of financial institutions, regulators, and payment systems. To function safely at that scale, the system must maintain the ability to intervene when necessary. If institutions lacked the authority to pause suspicious activity, financial crime would be far easier to execute. If they could not restrict accounts under investigation, regulatory compliance would collapse. If they could not manage liquidity flows, the stability of the financial system itself could be threatened. So the system requires authority, and that authority must exist before problems appear, which means the authority must be written into the agreements governing every account. Most people accept those agreements without hesitation, not because they fully understand them, but because participation in modern economic life requires access to banking infrastructure. Salaries arrive through bank transfers. Bills are paid electronically. Commerce increasingly depends on digital financial networks. Operating outside that system is difficult. So participation becomes almost automatic. Opening an account feels less like signing a legal contract and more like activating a service. But legally, it remains a contract. And that contract defines the boundaries of financial access. The contract explains that deposits are not stored separately in your name. Instead, deposited funds become part of the bank's balance sheet. In exchange, the bank records a liability promising to repay the depositor on demand. This structure forms the foundation of fractional reserve banking. Deposits support loans, financial markets, and liquidity operations across the economy. The depositor retains a claim against the bank. But the funds themselves circulate inside the banking system. That distinction is subtle. Yet it explains why the bank retains authority over the account infrastructure. The system must manage deposits collectively to maintain stability. Individual account access therefore operates within institutional rules. Those rules include the right to intervene. Once that idea becomes clear, other aspects of the financial system begin to make more sense. Why transactions pass through approval systems? Why transfers occasionally pause? Why accounts can be restricted without immediate explanation? The system is not reacting spontaneously. It is operating according to the conditions embedded in the agreements that govern participation, agreements most users accepted without studying. Because the system presented the choice as routine. Accept the terms. Open the account. Use the service. But the agreement does more than define rights during unusual events. It also establishes the everyday structure of digital financial control. Every electronic payment travels through networks operated by financial institutions. When you swipe a card, send a transfer, or pay through an app, the transaction request enters a series of evaluation systems. Fraud detection algorithms analyze spending patterns. Compliance databases screen identities. Risk models examine the behavior of the account. If everything appears normal, the transaction proceeds. But if the system detects something unusual, it may intervene. A transaction may be declined. A transfer may require additional verification. An account may be temporarily restricted. These actions feel sudden to the person experiencing them. But from the system's perspective, they are simply part of the rules that were accepted from the beginning. The agreement allows the system to operate this way, because the system cannot function without those controls. This arrangement reveals an asymmetry built into modern finance. Individuals participate in the system. Institutions govern it. That asymmetry is rarely visible when everything works normally. Payments clear instantly. Balances remain accessible. The system feels seamless. But the authority embedded within the infrastructure never disappears. It remains present in the background. Evaluating transactions. Monitoring accounts. Applying the rules that were accepted long ago. Over time, this structure has become even more powerful as financial infrastructure has become increasingly digital. Digital systems allow institutions to monitor transactions across enormous datasets. Machine learning models analyze patterns of activity in real time. Compliance software screens global payment flows against regulatory databases. This technological capacity improves fraud detection and regulatory compliance. But it also reinforces the system's ability to intervene in financial activity. Intervention does not always mean restriction. Often it simply means evaluation. But evaluation always carries the possibility of denial. And that possibility exists within every transaction. The system decides. Not because it wants to control individual behavior, but because maintaining the integrity of financial networks requires constant oversight. Every account exists inside that oversight. And every account holder accepted the framework that makes it possible, without fully noticing. This quiet acceptance reflects a broader pattern across modern financial systems. Participation requires agreeing to rules that prioritize systemic stability over individual autonomy. Those rules are rarely presented as dramatic changes. They appear inside contracts, inside software updates, inside regulatory adjustments that slowly reshape how financial infrastructure operates. Most of the time, these changes do not interrupt everyday banking activity. The system continues functioning smoothly. But the underlying authority remains embedded. If circumstances require it, the system can act. Not because the authority was suddenly created, but because it was always there, already written, already agreed to, already integrated into the structure of modern finance. And once that becomes clear, the relationship between individuals and financial institutions begins to look slightly different. The account still displays your balance. The card still works most of the time. The payments still move when the system approves them. But beneath that normal experience lies a framework of agreements and controls that most people accepted without ever fully examining. Agreements that allow the system to manage money not only as a service for individuals, but as a network designed to protect itself. The network must maintain order across millions of participants. To do that, it must retain authority over the infrastructure. Authority over transactions. Authority over access. Authority that was quietly accepted long before the moment anyone thinks to question it, not through deception, but through routine. Through agreements accepted during moments that felt too ordinary to examine closely. And those agreements continue operating quietly every time the system processes a payment, approves a transfer, or evaluates an account. Most of the time, the system simply allows the transaction to proceed. But the authority to intervene was never temporary. It was part of the structure from the beginning, accepted, signed, and rarely noticed.